Good morning, good afternoon, everybody. As I think you all know, my name is Rob Whittall, and for those of you who've been on these webinars before, this is the 7th in our series of Meet the Expert series. And today, the experts are actually going to be Julie and myself internally. But the whole purpose of these webinars that we've put on is the fact that obviously doing business in the UK is a lot different than doing business in the US. So the purpose of these webinars is to try and help people understand some of the different concepts in the US. Today we're going to look at sales tax, but whenever we do any of these webinars, we try and do them by referring back to how the UK treats a similar sort of tax. So from a US perspective, this would be VAT. So we'll talk a little bit about VAT, talk a little bit about sales tax. But first of all, I'd like to introduce you to Julie Koschik. Julie and I used to work together many years ago, and then Julie has had experience both in private practice and also in industry itself. So this is great. And Julie came on board about 12 months ago and has been a great addition to our team. So between Julie and myself today, we will be going through sales tax in the US. And as always, on your screen, you should be able to see that you can submit questions. So please submit questions as they come along. If the question at the end, when we look at it, is potentially very specific to your situation of a technical nature, Julie and I will get back to you afterwards because it's mostly just specific to your situation. But if we get questions that are of a general nature, which we believe would be useful to everybody on the call, then we will answer them. And any questions we don't get to during the webinar, we will address afterwards. So without further ado, we will move on with our topic today of Sales Tax 101. So first of all, I just want to go through the agenda of what we want to address today. So obviously, we're going to talk a little bit about VAT and how that corresponds to sales tax and some of the likenesses and differences. We'll talk about the concept of nexus, exemption certificates, what sales tax rate you charge, which is based on, is it an origination sale or a destination sale? We'll talk about use tax. We'll talk about the sales and use tax of filing returns, and then one or two miscellaneous issues, which should take us up to about 45 minutes. And like I said, with the last 15 minutes, we will talk through any questions that we have. So to start the conversation or the dialogue today, I first of all wanted to set the scene in effect with how does VAT work? How does VAT work in the UK? I think everybody who's mostly on the call understands VAT, but I think it's important for us just to go through it again so that then you can relate that to what I'm going to tell you about sales tax. So obviously with VAT, the VAT is when, if you're VAT registered, every time the widget, for example, changes hands during the supply chain to the end consumer, is that you charge output VAT when you make a sale, and then if you're the recipient and you buy that sale, it's input VAT. And in effect is you pay over the difference or reclaim the difference depending on whether your inputs or outputs are greater at the end of the month or the quarter to HMRC. And at the end of the day, if the supply chain is all between businesses, in effect is, and everybody's VAT registered, it's just the timing of cash flow, because ultimately the end of the day is if you charge VAT, you sort of pay it over from the customer, and if you pay it over, then you reclaim it back as a refund. So at the end of the day, it should be a net cost to the business. As we'll see in a minute, that is not the case for sales tax. Once again, with VAT, as everybody most probably knows, is you don't charge VAT, or you don't have to register VAT unless you have a certain level of sales in the UK, and as everybody knows, in the EU, there's limitations there. And also, if you go below a certain level of sales, you can deregister it if you want. And everybody most probably knows there's benefits and detriments to each of those situations. Where we want to talk a little bit about VAT and how it'll tie in with the US sales tax system is obviously with VAT, and when you're exporting, or when you're meaning exporting to the EU or exporting outside the EU, anybody who's involved in that will know that when you've got goods going outside, in effect is you don't charge any VAT on. They'd be outside the scope of VAT, or if you're into Europe, in effect is as long as you get a valid EU VAT registration number, then in effect you don't have to charge VAT going cross borders. That'll become, bear in mind that, because that'll become an important concept when we talk about sales and use tax in the US going across state borders. So in effect is, if you look at the US as being subdivisions, a bit like doing business in the EU, I think that'll help you understand how sales tax and use tax works in the US. So how does sales tax compare to VAT? So sales tax is really a consumption tax, and it's an actual cost to the ultimate consumer of the goods, even if you're in a business. So let me give you an example here, and I'll give you an example from, I suppose, our perspective as accountants. So we've got a company in the UK, we've got a company in the US, and obviously we need computers. So in the UK, when I go out and buy a computer to do the tax returns, I'll go out, I'll pay for the computer, say £1,000 plus VAT at 20%. So I write a check or pay by backs £1,200. When I then file my VAT return at the end of the quarter, I will claim that £200 back. So in effect, the net cost of the business is £1,000. In the US, in that same situation, so when we're sat here in Cleveland and I go out to the local shop and I buy a computer, and the sales tax rate here in Ohio is 7%, and I buy my $1,000 computer, I will go to the till, I will be charged $1,070 for my computer. From a VAT perspective, you go, okay, well, the computer still costs you $1,000 because I claim my $700 back. No, I don't, unfortunately, because even though I'm a business and in effect would be the equivalent of VAT registered in the UK, because I'm the ultimate consumer of that computer, so I'm not selling it on or it's becoming part of another product, is I have to pay that sales tax. So you can see immediately that between VAT in the UK and sales tax in the US at a business level, there is a difference. In general, sales tax used to only apply to goods in the US, whereas in the UK, VAT applies to goods and services. The majority of the time, everybody knows there's certain zero-rated sales and exempt sales, but in general, goods and services are subject to VAT in the UK. The general used to be that sales tax only applied to goods. However, what you also have to remember is that once we get to this sales tax nexus, which we're going to talk about, or Julie's going to talk about in a minute, is that once you have a sales tax nexus, then you have to charge the appropriate rate and pay it across the appropriate state tax department. So the easiest thing to think about that from a VAT perspective, it would mean you'd have multiple registrations in the EU, you'd be filing in multiple countries, and you'd be charging multiple VAT rates. So that's where we potentially get into the complexity from a compliance perspective in the US with sales tax. As we talked about before with VAT, there are registration limits before you have to register for VAT. In the US, there normally isn't registration limits for sales tax. So it's not like $80,000 in one state or $100,000 in another state. You're normally either subject to sales tax or not. Julie will talk a little bit about, which is important, about how maybe if you're doing a trade show, whether you're subject to sales tax or not, but we'll talk about that a little bit later. Does sales tax apply to services? The general rule used to be that it didn't apply to services, but what's very important to realize about sales tax is every state in the US is required to balance its own budget. And sales tax is a very important revenue raiser in the US. So what's happened is, because the supply chain or the way of doing business in the US changed drastically through the internet and through online services and stuff like that, a lot of things, or a lot of things that they used to be able to claim sales tax on aren't. So like I said, the general rule is services aren't subject to sales tax, but every state now is short of money and they're changing their rules, and there's certain times when services would be subject to sales tax. So any situation, you have to look at it, see what your situation is, and find the answer. But what's important to know is we had a situation where it was actually in the state of California, where we had a client that did some work there, and it was a combination of goods and services. And to start with, they had just sent an invoice for everything together. Because there was goods in there, then in effect the whole amount was subject to sales tax. So obviously, because the customer couldn't reclaim the sales tax back, even though they were a business, the fact that we had to charge sales tax on everything became a lot more expensive. So we got involved and had a look at it, and we were able, under California rules, to look at it and sort of unbundle it. And what I mean by that is we were able to put on an invoice and then separate out the goods separately from the services provided, and then in effect not have to charge sales tax on everything. But also, where it gets even more complex, is some of the services that were provided, we actually had to look at those in more detail and some of those were subject to sales tax and some weren't. So, but definitely if you are in a business where you are supplying goods and services, it's very important to look at it and see if we can unbundle what you are selling to your customer to reduce the sales tax burden, assuming that your customer isn't able to give you a sales tax exemption certificate, which Julie will talk more about as well. And finally, just as an introduction, is how is sales tax applied to goods and digital goods and services? This is a continually evolving situation, as everybody can imagine, because business changes far quicker than tax law can ever change or tax law can be implemented. So I remember looking at a digital goods question maybe about 5 or 6 years ago, and at the time it was as long as you didn't provide anything like a CD disk or a dongle or anything that with your software on, it wasn't subject to sales tax. But now those rules are changing, and certain states are starting to tax online goods and services because they are short of revenue. So let's get into maybe some of the more detailed issues with respect to sales tax. And the first one we'll talk about is Sales Tax Nexus, which Julie will talk you through.
Okay. Good morning, everyone, or good afternoon. So Sales Tax Nexus, and the word nexus in particular might be new to some of you, but that's really how the states determine where to collect revenue. So let's talk about nexus, and it's defined as a series of connections linking two or more things. And in the situation, the perspective of sales tax, what the states have done is try to determine the links of sufficient physical presence of a business that might connect that business to the state that they're in. So the physical presence, you will think about property and people. And in the terms of property, you'll want to consider if you have personal property such as inventory or stock that you're selling to your customers, or if you have computers or furniture and equipment that you have in your office space. Those types of examples would be personal property and would constitute a physical presence in a state. In addition, if you had real property such as a building, or even if you rent your office space from a rental company, that would be considered a physical presence. On the other hand, you want to consider where your people are, and if your people are present in a certain state, that would be considered a presence. Those could be people on your payroll or people not on your payroll, independent contractors or sales reps who might be out and about soliciting sales of your product throughout the states. And in these cases, you'll want to kind of assess where your people and your property are to determine if you have a presence in a certain state.
So Julie, let's talk a little bit more about the physical presence and people in a state, and maybe give a few examples. So quite often we might have a situation where we have a client coming from the UK to the US, but they don't own their own property, their own place of business, but they've maybe got some stock over here that's sitting in a warehouse, a third-party warehouse. Does that give them a nexus for sales tax?
It will. If you have property sitting in a warehouse in Ohio, then you have a presence in the state of Ohio, and you'd be expected to charge sales tax on your sales.
And then also when we're talking about people on the payroll, so obviously if we're here in the US and we've got an office and we've got people sitting here in, say, Cleveland, Ohio, that's fine. But I think what you're saying there is if those people in the office have their role is to go out to different states and solicit sales and sign off on sales, that potentially can give us a nexus in that state as well. Is that correct?
That's right. You need to track where your people are moving and selling throughout the year.
And what about, I think you did just touch on it, but I think this is a very important point. What about if you've got independent contractors or independent sales agents? Do they cause you a problem?
They do, and something I think you want to look on a state-by-state basis to be sure that the state they're going into would treat them as a nexus property.
And my understanding with these rules are that, in effect, is unfortunately, I don't think, except we're going to talk a little bit about trade shows just in a second, but outside of trade shows, it's very much facts and circumstances. I don't think there's really any states that like have a bright line test that said if you have a salesperson here 10 days a month, you've got a nexus. If they're here 9, they're on. It's very much facts and circumstances, is my understanding.
That's right. And I think it's good to just keep track of where people are and what they're doing. If they're making orders or if they're more advertising and marketing when they're out. Next on the list is trade shows, which kind of goes into the stems from the solicitation we've been talking about. And trade shows is a pretty big topic, and most of the states will have a specific line item and language in their on their websites that you can refer to learn about how they handle Nexus as it relates to people coming into their state on a short-term basis to generate sales, solicit sales, or even make orders. And so again, these states, the rules vary state by state. Some states do have a de minimis rule that you can use to eliminate the registration requirement. In Ohio, I know there's a de minimis rule that states that if you come in less than 7 times a year, that you wouldn't need to register. Up north in our state of Michigan neighbor, they have a rule that says if you're there for less than 10 consecutive days a year, so that might come in handy for you. But in contrast, if you go into Nevada, which is a very popular trade show state, they're more strict with their rules, and they have the only allowance for not registering is if you're not making any sales, and that's only a one-time permit. So again, it's something you want to keep your eye on. I would suggest a calendar of some sort that you can track who's going where and be specific about what they're doing at those shows. If you're taking orders, you're going to subject yourself to some scrutiny.
Because basically they're saying by taking orders you've made a sale.
Right.
It just hasn't been delivered, but you've concluded the sale, and that's one of the triggering factors.
That's right.
And I think it's interesting there is just seeing the different rules between Ohio and Michigan. So if I understand Ohio, so if there was trade shows in Ohio and they each lasted 4 days, you potentially could be in Ohio for 7 times 4 days, 28 days.
I think so. Ohio is more of an instance, like 7 specific trade shows. Michigan has the day calculation.
Yeah, so in effect, yeah, so that, I suppose, just to, reiterate is every state is different, and you just need to know those rules. But a lot of for what we've found with our experience with different clients is a lot of states do have de minimis rules for trade shows, but you just need to know what they are, whether they're a day's basis or the amount you can attend, or as you said, Nevada being a state that is renowned for conferences, obviously they see it as a big revenue raiser. Because Nevada is a state that doesn't have an income tax, so they have to look at other revenue raisers. So this is one they do because they know a lot of people go for trade shows there.
Right. Next on our list is economic nexus, and this is sort of goes along with what Rob was discussing on the changing economy coming from so much e-commerce and internet-based sales, that the states are starting to look at getting away from a physical presence determination for nexus and more of an economic presence test. And the examples we've seen so far are that they're going to measure economic nexus based on the sales or gross receipts in a certain state in a year, even if there was no employees there, even if there were no inventory or stock being held in the state. And I believe you said we noticed there were 6 or 7 states that have this pending in legislation.
Yeah, so definitely from an income tax perspective, we know a lot of states have already gone to this economic basis that if you've got a connection to the state and you do so much business there, then you're going to have to file an income tax return. Sales tax is catching up with that, but the big difference with sales tax is there's a sort of a case out there called the Quill case that basically originally said that to have a sales tax nexus, you would actually got to have a physical presence. So where states are now saying you don't have a physical presence, people are challenging it and saying you're sort of going contrary to what this landmark case was saying. So I know when you and I have looked at this, some states have pending legislation, some have tried to put it in and it's got revoked at the moment. But I think we all believe in the long term, because so much sales tax has been lost because of the way business is done, is they're going to have to go towards the economic basis or find some other tax base, because there's so much revenue being lost. So I think this is an ever evolving, and I think it will affect more and more of our clients that don't have a physical presence in a state, don't have a physical product that's going in there, but are doing business in that state via the internet.
Mm-hmm. I guess just to wrap up on this slide, well, I guess we should say if you don't have a physical presence in a state, then you can issue your invoices as as normal. You wouldn't have to separately state. And then if you did have sales tax, you would want to start calculating your sales tax on your invoice. You want to separately state that, show the rate you're using, and include that on your invoice. And I guess if you are in a state, then you would have to start getting registered, and we'll talk about that next.
So I think what you're saying there, Julie, is that if you determine, so you're obviously going to, where this becomes a bit more complicated, you're obviously going to have a nexus where you're based here in the US. So if you've got an office, you've got people here, that's pretty much black and white. Where it's getting a little bit more grey and where we need to do, or our clients need to do more analysis or think about it more, is where they then have do they have a sales tax nexus in other states where they don't have necessarily a physical presence, but they're doing business there. And what you're saying is if when you've done that analysis, you find they don't have a physical presence or a nexus in those other states, when they make a sale to a customer in those states, they don't have to worry about charging sales tax. But obviously, if a sales tax nexus is determined, then as we're going to talk about registration, but there will be a sales tax issue in that state.
That's right. So that's what we'll talk about next on the next slide. The first step there is sales tax registration. So if you do find yourself with a presence in another state and you need to register, the first step you'll need to do is to probably contact your attorney or your registered agent to have them help you get registered in the state. So you'll need to go along the lines of the Secretary of State registration and get a qualifying number so that you're authorized to do business, make sales in whichever new state you might be going in. After you have that, that's usually the first piece of information you need to start an application with a state. You'll go to the state website, typically the Department of Revenue, and complete an application for your sales tax registration. Some of the things they'll ask for will certainly be, the physical location that you're in their state. They'll ask about what type of product you're selling, how much you think you're going to sell. They'll ask for a sales forecast, perhaps. They'll probably ask about ownership of the entity, which might require a driver's license number to be submitted or some passport information. And then based on your information that you provide them, they'll give you some sense of how often you'll have to remit and report your tax. Once you submit the application, getting a vendor's license number or a seller's permit number is pretty quick, turnaround maybe a couple days. And then once you have that number, then you're registered to collect sales tax in that state. And then as you're making your sales to your customers, the first thing you need to remember is that the assumption will be that all sales are subject to sales tax unless your customer provides a tax exemption certificate. And so usually when you're getting a new customer and you're starting that discussion with them, that topic will come up, and they might offer, or they should probably offer to you an exemption certificate so that their invoice would be clear of a sales tax charge. So there's a number of different exemptions that customers might provide you, and we'll talk about 3 of them here. The first is a resale exemption, and that's going to be used in the case of someone or a company who's buying a product from you, but then they're going to turn around and sell it to someone else. Maybe they're selling it in a storefront, maybe they're selling it to another wholesaler, and what else was that about?
So when you resell, so basically in effect is when you're reselling it and it's coming in and out, in effect is if they give you a sales tax exemption certificate. And once again there's nothing that so from a VAT perspective in the UK, there's a website you can go on if you're selling into Europe and you can look up VAT numbers. And if you find the VAT number there, that's good due diligence, so you don't have to charge any VAT for an export to Europe. In the US, there isn't anything you can do like that to check, but as long as you're provided with the sales tax exemption certificate and to you it looks reasonable, accurately completed in that, you are able to then reasonably say that you didn't have to charge some sales tax and you can send the invoice with no sales tax charged. So that was with the resellers. The manufacturer's exemption.
Okay, another one that might come up would be a manufacturer's exemption, and that's if your client is a manufacturer and they're going to put your product in their product, they can provide you that exemption, and then you could omit that one from sales tax as well. If you are a manufacturer and you're providing that to your customer, you want to have a full understanding of where that product is going to go into your manufacturing process, and to make sure that you understand where your process begins and ends, and that if you're using that exemption, that you're using it in a true as part of the process of the product you're manufacturing. Because oftentimes if you don't pay sales tax on a product that occurred before the product began its change, then that should not have been excluded.
I think the other one as well, which we just don't, it sort of ties in a bit with the manufacturer's exemption, is if you are in a situation where, as part of your manufacturing process, you are building some equipment, and that if you buy parts for that equipment, because it'll go into the machine that produces the final product. Very often, those pieces that are going in are not subject to sales tax, because it's regarded as being part of the process that will ultimately produce something that then you would charge sales tax on.
Right, that's right. The last one we have here is for not-for-profits, government agencies, schools, municipalities. And in this case, it's going to be a very state-by-state basis. If a not-for-profit or a church or someone is coming and saying, I'm going to use this in my not-for-profit organization, then that might be qualify as an exclusion from sales tax. Again, I think those rules vary state by state, so you want to be sure you're complying with the state that you're in.
I think the other thing we want to talk about, because we talked about earlier on in the UK, that sometimes if you get to a certain level, you have to register for VAT. Otherwise, you can sometimes voluntarily register for VAT. We had a recent situation with a client that was based out of the UK but was buying a product in the US. That because their vendor had a nexus in that state, they were going to have to charge them sales tax, which would have been a cost to our client. So we had to, in a sense, voluntarily register for sales tax in that state, even though we wouldn't have needed to, so that they weren't charged sales tax. So sometimes you will voluntarily register to save that. What happens, Julie, we have sometimes a situation, what happens is if you get charged sales tax and you shouldn't have been charged sales tax, do you net that against your sales tax liability, or how do you get that sales tax back that you shouldn't have been charged?
Now that'll be a little more complicated than what you might be used to in the UK on your VAT returns. In this case, you'll need to go back to the vendor that you purchased something from, or your customer might come back to you and say, oh, I made a mistake, I should have provided you the certificate, the exemption certificate, when we made the sale. I'm a little late. In that case, the seller would have to return the funds to the buyer.
So there is, unlike in the UK where there's almost like a netting basis, in the UK there isn't a netting basis. You have to go back to your vendor and get the refund from them, which obviously sometimes can cause a few problems.
That's right. That's right. So once you're registered and you're set up and you have your vendor's license number, and you have to think about what rate you're going to put on your invoices. So we've got 50 different states here in the U.S., pretty much 50 different legislative bodies. We've got 45 states that have a sales tax. You can be sure that there's 45 different rates that they have. There's 5 states with no sales tax. And so this is something you got to keep your eye on and keep up to date on. So the other thing that's different about our states is that some are an origination-based state and some are a destination state. And the difference between those two would be that in an origination state, you're going to tax your products based on where your products are shipped from. So in Ohio, we're an origination state, and so all of our sales out to our customers would be subject to the Ohio state rules. And in the state of Ohio, we also have a flat state rate, and then we have a county rate, and then sometimes we have a local rate. And so we need to be aware of all 3 of those as we initiate and charge our customers.
But what we're saying, because Ohio is an origination state, so if it goes from the county of Cuyahoga, in effect, it then goes to Portage County or something like that, which would be another county with a different rate. Because it was going from Ohio, from Cuyahoga, we would only have to ever worry about Cuyahoga's rate, not Portage's rate, because it's an origination state.
That's right. That's right. Now, the other side of this could be a destination state, and that's where we charge sales tax based on where the products are delivered to. And so in that situation, you're going to have to keep your eye on, number one, you have to understand where your nexus is, because if you are shipping to a customer who's in a state where you don't have a presence, then you would not be required to charge sales tax on that invoice. But if you do have a nexus in that destination state, then you would have to understand those rules in that particular state as you're preparing your invoice. And I think as your customer base is spread and your employees' sales force spreads out, you're going to have to keep an eye on that.
Now, I know with a lot of programs out there that, in a sense, are set up to help people with sales tax and sales tax compliance, I believe a lot of them are driven off zip codes very often. But the trouble is, as you and I know, Julia, sometimes zip codes cover an area that actually spans two local tax rates or two district rates. So you really need to be careful that when you do have sales tax issues in destination states, that you actually do know which county or district that you're in, and that sometimes the zip code might not give you the correct answer. I think what's interesting, as we put on here, is, as with always, California we always joke in the US, California is its own country and has its own rules. And California has an interesting rule that sort of says that it is originally an origination state, which means that if you have a nexus in California, you charge where you ship from, but it also has a district rate for destination. So you get in a situation that if you were in a county in California and you would charge that rate, but then the purchaser who's in California as well is supposed to charge themselves their use tax for where they are as a destination. Now, you as a business can always be very kind to them and basically charge the origination rate for state and county and also collect their district rate to save them having to do it. But then that just makes your life a lot more complicated. But like I said, California is a mixture of origination and destination, which is just a pain from a compliance perspective.
So I guess just on the tax rates, I would make mention that on your invoices, you'll want to separately state your tax that you're charging them, separately state the sales tax, and it might be another good idea to include the rate you're using. And if it's a state rate and a county rate and a local rate, if you separate that, that might help people understand what you're charging.
I think another useful thing, just I suppose a tidbit, that when anybody is signing up for sales tax and registering for sales tax, most states now allow you to log on or sign up for their email notifications, don't they? Mm-hmm. And I think of all the things you get notification for, sales tax is most probably the one you need to sign up for, because if a rate does change, then you should get notified a rate's changed. Otherwise, you're going to have to keep going on the website and checking if a rate for a certain area has changed if you're doing a lot of business in the same state.
Okay, so next up is use tax, and this is going to be a little different than what we've been talking about. We've been talking about sales tax of when we charge our customer. Use tax is different in that it is the tax we should have paid as a vendor, but wasn't included maybe on our original purchase invoice.
So Julie, maybe let me just set the scene here a little bit as a scenario, so that hopefully it'll help people understand. So if, for example, I am in Ohio, so Rob Whittall Inc. in Ohio sells a widget to Julie Koschik in Kentucky, I don't have a nexus in Kentucky at all, so I don't have to charge you sales tax because it's going across a state border. You, in effect, sitting there learning a little bit about sales and use tax, you're most probably going, crikey, it means that I can buy it off Rob with no sales tax, but I buy it off somebody in Kentucky, they'll have to charge me sales tax. I'm going to buy it from Rob, so I'm at a competitive advantage. But that's where use tax comes in, isn't it? So if we look at it in that situation, how does use tax affect you being in Kentucky?
Use tax I'm going to have to pay the tax on what I'm bringing, that product that I'm bringing into Kentucky. And I'm going to report that to the state on my own. I think that's the biggest trouble with use tax, is that it's a self-assessed program. And with that, we have to rely on ourselves. We have to not put this type of thing off. We need to tabulate all those purchases that we bought that weren't charged sales, that we didn't pay sales tax on, and we've got to come to the state and pay that tax over. The risks of not doing that are becoming more and more relevant, and that is by way of audit. Often the states, like we've mentioned, are looking for ways to find revenue and collect lost revenue. And what they're doing is they're matching up those taxpayers that are in their state system and seeing if they have a sales tax registration and see if they're paying use tax. And if they're not, they might come looking for you and to find out what's happening at your business. And if you are selected for an audit, it's a huge time burden on everybody involved. They will, number one, it takes forever to get it done, and the auditor will come in and they'll want to look at all of your invoices, and they will assess, or they will pick out line items from your invoices that they deem potentially use taxable. And then you as the taxpayer will have the burden of proof to argue that perhaps they weren't. And it's a kind of a daunting experience. I went through it recently with another client, and it's stressful for everyone involved. And the takeaway from this is just to get yourself registered in the system, start filing some use tax returns based on your best calculations. And by doing that, you can prevent an audit from going back 6 years, which is if you register with the state, your statute of limitations, they can go back 3 years. But if you're never registered, they can go back as far as 6 years. And so that makes the audit period, doubles the audit period and doubles the chance of exposure. Not to mention the tax and the interest and the penalties that would be involved based on the amount that they assessed.
But I suppose the concept of use tax at a very high level is to make sure that, in effect, there isn't a competitive advantage for buying from out of state as opposed to buying in state, because the idea is ultimately the same. You would pay the same tax in reality. So that's the high level purpose, to put you on an equal competitive basis from a business perspective. But I think also the other thing that we talked about yesterday a little bit about, where you've got to be careful with use tax, is that say you buy in widgets, and for whatever reason within your business you use some widgets to manufacture something, but you also use some widgets to do something internally. Maybe let's use nuts and bolts or something like that. So you're buying in some nuts and bolts to construct a piece of equipment which you sell on. But at the same time, some of those nuts and bolts are used to mend the racking or whatever you've got in your warehouse. You've got to be careful and track, in a sense, those, and you wouldn't have paid sales tax on any of those widgets because you were basically, when you bought them, we're going to resell them or put them in a product. If you take those out, then you need to make sure you adjust for your use tax, because now you are using those internally, and you actually would have to pay use tax on those.
That's right. My former client, that's one place we got tripped up, and we bought a lot of products from a shop supplier that we used as part of the manufacturing business. Well, then we started, I don't know if they had a sale or what they did, but they offered a deal on janitorial type supplies, and we started buying those from them. Well, those certainly aren't qualified part of the manufacturing process, and so those were all excluded and tagged. But because when we originally set up our relationship with that vendor, we thought we'd be buying all excludable products, we never caught the fact that we had missed a handful of others, and those got pulled in for 6 years.
And the reason that was missed from the original thing was because when you first gave your sales tax exemption certificate to them, that's what they had on their records. So when they were processing everything, they just automatically didn't think to ask you, because you bought something different, do you need a new sales tax exemption? So then it just becomes who spots it, because it's an easy mistake to make, but it can be a costly mistake to make.
Very costly. So one other thing, just the use tax will most regularly be part of the Department of Revenue's website. You can file those returns the same way you'll do your sales tax, which I think we'll talk about next. Yes, sales tax and use tax return. So now that you've registered and you've started adding sales tax onto your invoices, the state has let you know if you're a monthly or a quarterly or annual filer based on the level of forecasted sales you expect. You'll simply go online every month or quarter and complete your form. Typically you have 30 days from the end of the reporting period, and you pay your tax online. I would say a sales tax return is really straightforward. You will show probably gross sales, exempt sales, get to net sales, and then show the tax that you've collected, and then remit that. I think I'll just mention again what Rob said earlier about the importance of signing up for the email notifications from these websites, from these state websites, so that you get the most up-to-date information. And also the reminders to get your filings done is helpful.
Yeah, because the state will normally send you a reminder. If once you've registered with them on their portal or their website, they will normally send you the email reminding you when to file your tax return. We talk about here payments are normally made online, which it is, and I think of all the taxes that we pay here in the US, I think almost every sales tax, they want you to do it online. Mm-hmm. The problem what we have here sometimes is from our situation. So we could have a situation with the client we were talking about earlier, that if they are a UK company but for some reason have stock sitting in a warehouse, they've got a sales tax nexus, unless they've got a US bank account, that can be a real problem to pay online, because most of the state sales systems are set up to have a routing number and account number, which a UK bank account has a sort number and account number. So this is where a little bit of the problem starts, or make it a bit more difficult from an administrative perspective, is if you get into the system over here, you're most probably going to have to get a US bank account set up to be able to do these online payments. Otherwise, it's going to be another pain in the backside to try and sort stuff out. Mm-hmm. So I think, Julie, I think we've walked through everybody there and done a really nice job of trying to explain the various things with that. In the last sort of 5 minutes here of sort of our webinar, I want to talk about some other things that actually I think affect that we should be aware of. The first one is what we call affiliated nexus. And where this comes up, let me set the scene again here with a lot of the clients that we deal with coming from the UK to the US, is you've got the UK limited company that sets up a US subsidiary in, say, for Ohio, for argument's sake. And if you're selling widgets or supplying in the US, very often still we will have the US operation as maybe a sales or after service operation. So really providing ancillary services. And in effect, the product or the widget is still being shipped directly from the UK company to the US. So if that product comes over and is shipped to California, where we have no sales tax implications over there, no nexus over there, and it's shipped with a common carrier over, is in effect is because we don't have any nexus, we don't have to, the UK company or the US company doesn't have to worry about any sales tax issues because of the fact that there is no nexus there. The customer in California would then, as we talked a few minutes ago, would then be subject to whether it needed to self-assess itself, use tax on that widget, on that service, whatever was in California. However, what happens is if we now are in Ohio with our subsidiary and we have a customer in Ohio who buys directly from the UK company, this is where this affiliating nexus comes in, because what the state said is, in reality, is you have a presence here. The UK company has a presence here in Ohio due to its 100% owned subsidiary in Ohio. So if the UK company sells into Ohio and it has got a nexus as well, so it would have to register for sales tax if required to, because of the product or the service it was providing. And in effect, is that becomes an admin nightmare as well. So very often in those situations, what we sort of have our clients do is they will, for that one sale, will actually sell from the UK to the US subsidiary. The US subsidiary could then give the UK company a reseller's exemption certificate because it's going to sell it on, and then the US company would sell on to the customer in Ohio because it's most probably already registered for sales tax. So it's very important to understand about this affiliated nexus, that when you've got group situations that we have, very often your parent company in the UK can be pulled into the sales tax arena and nexus because of the nexus of its subsidiary in the US. The next term I want to talk through here a little bit, and this is coming to bear more importance as we go online and everything, this click-through nexus. So how does this work? And once again, this is pending legislation in a lot of states. Some states have gone with it, some states have appealed it. But what happens here is, so we've got Rob Whittall Inc., who's in Ohio, and he has a bricks and mortar operation here in Ohio, is subject to sales tax. But on my website, I have allowed Julie, who's still in Kentucky, to advertise on my website. So people who come onto my website will maybe go on there and see what they actually want to buy is from Julie. So they click onto Julie's website, click through, is where we're going with this, and then in a sense they go onto Julie's website. Because Julie's company is connected to my company and it has a presence in Ohio, it would mean that Julie also has a nexus in Ohio as well and would have to be subject to Ohio sales tax rules if she sold something to an Ohio customer. So this may not apply to, I suppose, many of the people on the call here directly, but just be aware that if people are able to access your service or your product and that through somebody else, you may, by default, even though you might not realize it, have a nexus in that state as well. So we'd have to look at those rules, and it's state by state. Another situation that comes up on a regular basis for us is where we've got clients who are maybe using the Amazon FBA program here in the US, where they're shipping product from the UK and it's sitting in various warehouses. Because you've got stock sitting there, you've got a sales tax nexus there. But where it gets more complicated with Amazon is, I believe, with a lot of the people we talk to, is Amazon moves can move your stock around, your inventory around various warehouses, and you may not know where it is. So you may have a nexus in that state without even realizing it. So what's actually just come out recently is, because of this, there's a voluntary disclosure program that's basically running from the middle of August to the middle of October that's saying if you're caught by this situation, then in effect is you can come forward, become clean, get up to date, and they'll just start charging you sales tax on an ongoing basis. So of those we've just talked about there, I think with knowing who's on the call here, is I think the affiliated nexus one is mostly the one that you should be aware of, and just sort of start thinking about it is your US company can cause your UK company to have a nexus that you might not expect it, or a taxable presence. So with that, we're sort of coming to the question section. We've got a few questions that have come in while we've been talking, which we'll go through here in the next sort of 10 minutes. But the sort of one of the questions that sort of come in is, if you've got subcontractors in other states and the work they're doing and stuff like that, is there a threshold of hours that they need to work to before they give you a nexus? Once again, it varies from state to state. It also varies exactly what they are doing for you in that state. So it becomes a very more specific, but it's a good question, and it is something we need to be aware of from that perspective. From your experience, Julie, another question that's sort of come in that I think is an important one is, it sort of talks about is, well, how often do sales tax rates change, or how often do the rules change, sort of thing. Is from your experience, what would you normally advise clients to sort of check on various things with sales tax?
Well, I think rates might be changing all the time, and if it's a county rate, then that's a different legislative process than maybe what you're used to seeing on a state basis. So getting the alerts from your state Department of Revenue is a good idea. And then certainly I would suggest that at least annually that you do a thorough review of where your employees are, where your inventory is, who your new customers are. You know, if it's Amazon, what do we need to start thinking about there? And then maybe we can get together with Rob and I and kind of evaluate where our filing requirements and our exposures are. But definitely on an annual basis, you want to kind of take stock of where everything is.
Okay. And another question that came in, which is a good one, because from a UK perspective, when you set up an invoice in the UK, and you touched on this a little bit earlier, but when you set up a UK invoice, you have to specifically, under law there's certain things you have to include. You have to include your VAT registration number, and it's set out in a specific way depending on the size of the invoice. Is there anything specific that you need to put on a sales invoice in the US?
You don't have to put the sales tax separately stated on the invoice. It's not a law, but I would suggest it strongly because we've had a couple clients where the sales tax wasn't separately stated, and then the state could come back and assume that the whole invoice amount was subject to sales tax and then add it on top of that. So I would get the preparation of your invoices in a format and our template, which would separately state that sales tax and even include the rates that you're using get there.
But unlike in the UK where we have to put the VAT registration number on, there's no legislation that says you have to put the sales tax ID number on or the employer identification number. I've seen some invoices where they've got the employer identification number on, but most of that invoice is most of that information is very often gathered when they set you up as a client with a W-9. Mm-hmm. Following on from this topic, another question that's come in is from a UK perspective, obviously most people know it's inclusive or exclusive of VAT, or that's included on there and it's easy to work out, is what would your advice be to clients when they're quoting over here? Should they try and put the sales tax amount on or put some verbiage on it to sort of say that it's not with sales tax? What would you?
Well, I would say you don't want to let sales tax be a difference maker between you and a competitor. And so I would show your quotes before tax and then have some language in your quote that says this tax may be subject to sales tax or county tax or local sales tax, and would be added on to the invoice accordingly. I mean, you wouldn't know if the customer at the time was going to offer you or present you with an exemption certificate, and you wouldn't want that to be the reason that you maybe lost that business.
So I think, once again, to summarize there is that when you're in the quoting process, don't worry about the sales tax rate or the local tax rate on there, because whoever's buying you should be aware of that. But in a sense, make sure you put this is the price, and then make sure there's something in bold or that to say this is exclusive of any local state sales or local taxes that may be applicable, so they know in a sense what they're comparing to what.
Right.
Yeah. This is, I think this goes on before, but I think it's sort of it's worth iterating again. Is what happens, Julie, if you've bought product in or that, and for some reason you've used it? Very often in the UK we'll have goods for own use or something like that. When you buy it in, is what do you need to really make sure from a sales and use tax that when you start pulling stuff out of stock, out of inventory, that you keep track of?
So this is going to be an example of a use tax item. This would be something that if you did not pay sales tax when you bought the product because you were intended to use that as part of your product that you were going to sell on, so you didn't pay sales tax in the first round. If you pull those products back into your for your personal use or for the company use, then that would be something you should add on to your use tax calculation for the year. And at the cost that you originally paid for them, I would include those in your use tax calculation. And then the use tax rate would be the same as your sales tax rate.
I think we've basically got through our questions. There's a couple out there that require a little bit more specifics, and I'll follow up with those individuals afterwards. But there's just a couple of comments that I think I want to make before maybe, Julie, you can leave us with 3 or 4 takeaways that if people have picked up nothing from today's presentation at all, maybe 3 or 4 things that they should be aware of. But a couple of things that I want to sort of bring to people's attention is, one, the area of drop shipments with sales tax is a very complex area and needs to be looked at. So where you're maybe using a common carrier and you're buying from a supplier, but instead of it coming to your warehouse and then being shipped out again, it's going directly from your supplier to your customer. You need to be very aware that there's some complex drop shipment rules that can get you caught with sales tax when you don't. So if anybody has that situation, then they should contact Julie and myself, and we can look at that state-specific, the drop shipment rules for that specific state. The other thing I want to bring up as well is talking a little bit about sales tax audits and disclosure programs. So the US, a lot of the states have voluntary disclosure programs. So if you know you should have been charging sales tax or find out at a later date and haven't been, then very often you can go into one of their voluntary disclosure programs, because they obviously want you to be compliant. Normally in those, you maybe go back 3 years or 6 years, and sometimes the penalties are reduced by going that way, because you've thrown yourself on the sword as opposed to them finding you. But you do need to be very aware. It's quite often that the way that most people are pulled for audit for sales and use tax is not because of what they're doing, but because of what somebody else is doing. And what I mean by that is, very often maybe it's a big multinational that they go in and they start looking down the customer list or the vendor list, and they start going down the list, and what they're doing is they're pulling a list of all the vendors, the customers. Then they're going to go back to their database and see if those customers are paying or registered for sales tax. If you're not, then that's where they'll send you most of a sales tax nexus questionnaire to find out if you've got a nexus there, or send you an assessment. So just be aware that the way that you're more likely to be pulled if you're not registered in a state is via somebody else's audit. So that's how you're going to get caught most probably if you're not being compliant. Finally, Julie, we've got a couple of minutes left before we need to sign off for the day. Perhaps what 3 or 4 things do you think, if nothing else, people should be aware of and just take away from today to hopefully make their sales tax life easier?
Well, I think I'll add on to one thing you just mentioned, and that's the sales tax questionnaires. Oftentimes the states will be mailing these out kind of to see what they get, to see if anybody will respond. And I might suggest that our clients let us know if they get one of those and share it with us before they start letting the state know everything they're doing. So we could work on that together.
That's a good point, yes.
Yeah. Some other things I would keep in mind would be to keep that calendar of your sales force and find out, so you can document where they've been, what trade shows they've been attending, and what type of activity they performed when they were there. Were they making orders, or were they marketing, or simply advertising? That would be a good thing to have in hand if questions ever got asked. Another idea would be to consider your invoices and to break out the portion of your invoice that might be related to a tangible good versus a service. And that way we can easily determine if, what portion of that invoice is truly subject to sales tax and what might not be. I think we mentioned a couple times just keeping the alerts coming from your Department of Revenue website that you've logged into to file. Don't delete those, as we often do, or don't sign up for those, because I think those could, like I mentioned before, those rates and rules change all the time, and if you're in more than one state, they'll be prevalent. And finally, I would just caution and remind you to get registered for use tax. A lot of clients will put this off. They'll say, oh, I'll do that next year. Oh, it's really not that much money. But if you don't and you get caught, it does become a lot of time, a lot of attention, and a lot of money. And so if you just get in the system, get your name in there in that registration, you'll keep your nose clean.
Okay, well, thank you very much, Julie. We're coming up to the hour, so we're always cognizant of people's time. So we will sign off shortly, but hopefully somebody took things away from today, as we hope from all our webinars. We will do another one later in the year, most probably November, early December time. And the next one we're going to do, which we're finding coming up more and more with clients, is sort of thinking about pension plans and pension planning for employees and other benefits for employees. So that will be our next webinar later on in this year. So thank you everybody for attending, and hopefully everybody found it useful. So until next time, we'll speak soon. Bye-bye.